So I went through something like 60 years of data to try to answer this question for you today, whether now is a good time to buy into the stock market. And I'm going to take a look at something called fair value. Typically, I take a look at specific equities, but today we're going to take a look at the S&P 500 as a whole to determine where fair value is and whether obviously now is a good time to buy. So that's a difficult question to answer, but I'm gonna try. Before we do anything, my name is Bill Hawk. For the people who are new here, I'm an operator turned full-time investor, and on this channel I talk about my journey with stocks, crypto, real estate. So anything related to investing and making money. If you appreciate the content, I'd really appreciate it if you hit the like button and subscribe, because it helps me out with the YouTube algorithm. Fair value basically means what is the right price to pay, and this can be calculated at a very simple level using two things for the market. Number one is the equity or market risk premium, which is the price at which investors are willing to pay above the risk-free rate, or what T-bills are usually paying. The second thing is the earnings yield or return on equity, which is driven by dividends, buybacks, and of course earnings. And when we do this exercise, you're going to see over the last 10 years how drastically things have changed, how margins have improved. And of course, monetary policy has a big thing to do with this. Since 2000, we have seen a completely different monetary era, which we may not see going forward. At least that's going to be my assumption through this. So as I said, the market risk premium is the difference between the expected return on a market portfolio and the risk-free rate, which is often measured using the US T-bills or a 2-year Treasury rate. That's assuming, of course, the US doesn't default on its debt. And you can see in recent history, the market risk premium has hovered around 5.5% over the past decade. Historically, however, market risk premiums have varied drastically depending on the time and era, anywhere from 1 or 2% to as high as 15%. In general, the higher the risk premium, the more you're being compensated to take on the risk in equities. And of course, this shoots up in times of crisis. So when you take a look at March of 2020, for example, or 2008, you can see that the market risk premium shoots up. In 2008, for example, we can see it went up to around 8%. But that, of course, just lasts a day or so. So this is why you might even want to obsess over the implied risk premium calculation and look at it every day, as Aswath, whose work I'm going to reference. He's a professor at NYU. Throughout this video, he calculates the implied risk premium on a monthly basis, which I'll link below. You can access it. Right now, as of October 1st, his market risk premium calculations go anywhere from 4.3% to 6.2%, which you can see is in line with historical average. So the first question I asked myself when I saw these numbers was, am I actually being rewarded for the environment we're in right now by investing in equities? And the answer to that is a pretty clear no, I think. Given recent history, the premiums have been about 5.5%. So if I believe that right now is a riskier time to invest, I should be compensated with a higher risk premium, especially when real yields for bonds are positive right now. Why am I going to take that risk with equities unless I'm going to be rewarded handsomely? I hope you followed with me so far. If not, I'll try to clarify along the way. But the next thing I'm going to do is try to calculate the fair value of the S&P and the implied risk premium myself using Aswath's model. So let's go ahead and do that. By the way, the sheets that I go over on this channel, whether it be for specific equities or the markets as a whole, as we're doing today, are available to members of the email list for free, which is linked down below, as well as the Discord. And I'd love to have you on there because you can get live access to me and discussion. Again, it's completely free, so I highly recommend you sign up. So here is Professor Aswath's implied risk premium calculator, which he used to get his 4.3 to 6.2% implied risk premium right now. So I'm going to take a look at the assumptions and try to form my own, which is obviously something you should do all the time. So you can see my implied risk premium right now is about 4.8%, which is in line but lower than the recent historical average. So the same conclusion applies, in which I'm not being rewarded for the risk I'm taking as opposed to recent history. This is the S&P 500 level as of October 3rd, 3678. I'm using a cash and dividend yield of about 4.9%. And I'm getting this by averaging the dividend and buyback yield over the last 10 years. And you can see this over the last 10 years. This is something that's remained fairly constant regardless of the payout ratio, which is clearly increasing over time, and the return on equity and profit margin. So this is something I feel a little bit more comfortable in using to determine my cash yield rather than another calculation which Aswath proposes here. So I'm going to go with 4.9% for the yield on dividends and buybacks for my fair value calculation. The next thing you want to calculate is the earnings growth over the next 5 years. And you can see mine is a very conservative 2.09%. So let's just say 2%. Now, if you take a look at top-down forecasts for the S&P 500, you can see this is as high as 7%, 7.75%. But I feel a lot more comfortable using a 2% because I believe that we are likely in the brink of a recession, which I'm going to talk about later. So over the next 5 years, assuming we get a recession, a 2% growth rate is fairly conservative. Another thing that I did to be a little bit more conservative here is use, instead of the current T-bill rate, the Fed fund rates, which they projected to be the terminal rate of about 4.6%. I just used 4.5%, which allows me to consider that rate hike ahead of time. So this in theory should be more conservative. And finally, to determine my fair value, I use an equity risk premium of 5%, which is in line with recent history, to be a little bit more conservative and get a little bit more of a premium than we're seeing right now. And the growth rate after the 5 years is just assumed to be 4.5%, which is consistent with the risk-free rate here. So you can see my fair value calculation on the S&P 500 is about 3,500 with an intrinsic trailing PE of 17, and that's how we get the implied risk premium of about 4.8. So I would say based on these calculations, we're very close to fair value, if not at fair value already. We did touch it based on economic contraction that's going to take place in the next 5 years with a 2% growth rate. So looking at this solely, is it a good time to buy? Probably yes. But if you remember what I said earlier, the equity risk premium or market risk premium changes significantly in moments of crisis. So if your baseline is that we're going to have a crisis, which of course we can't rule out and the possibility is probably high, the equity risk premium is going to shoot up. Now this is another resource which calculates the equity risk premium and market risk premium, and you can see here in moments of crisis, for example, in March of 2020, the implied risk premium went up to 7%. And in 2008, the equity risk premium went up to 12%, and that's when the world probably feels like it's about to end. So are we going to get another event like that? I don't know, but if you're betting on it, then of course it makes sense to wait it out. But again, if you have a long-term view here, you really can't go wrong going into the markets here, in my opinion. So as you can see, if you buy in moments of crisis, you're obviously going to be rewarded much more handsomely. But of course, that's going to feel probably a lot harder than you think it's going to feel. But if that's your base case or you assign a high probability to that, then of course it makes sense to have cash aside. So although that's enough to conclude, I wanted to take a look at other metrics and other valuations and just other data points in general instead of ending this video here and share my thoughts with you. They may be a little bit all over the place, but whatever, just stick with me. The first thing I wanted to take a look at is the relationship between valuations and interest rates. Now, of course, as interest rates go up, in theory, valuations should come down. But as we just saw, market risk premiums might stay the same except in times of crisis. And you can see this in this relationship chart between the S&P 500 PE ratio and the 10-year Treasury rate. Things are pretty aligned with the regression line. Now, if we take a look at that regression line and compare current valuations, are we currently undervalued or overvalued? Right now, we are probably fairly valued. Now, again, if you take a look at moments of crisis, whether it be 2008 or 2000, we can go to 1 or 2 standard deviations from the mean. So again, can you time that perfectly? I don't know, but does it make sense to hold chips aside? Probably. The other thing I was curious about while doing my research here was, is there any relationship between earnings yield and bond yields? And there's actually something coined the Fed stock valuation model by Yardeni, which might not be as relevant anymore after 2000, which you can see here in this chart. Historically, it appeared that the S&P 500 earnings yield was in line with the bond yield for the 10-year, which as soon as it breaks, it was either overvalued or undervalued. And now based on that, you can see we're currently undervalued. After 2000, there was just so much more monetary stimulus that maybe this model is just not as relevant anymore. But if we do start seeing S&P 500 earnings yield minus real bond yields going towards zero, then you can surely bet I'm running for the exits with my chips, because anybody who did it in 2000 is obviously not regretting it. So if you're following along, you're probably wondering, what are the chances we get some sort of black swan event or a deep recession? Now, of course, I don't think I'm smart enough to answer that question, and I'll be honest with you, but the thing I do know is that inversions on the 3-month and 10-year yield curve has successfully predicted all recessions in recent history. And although we're not fully inverted yet on the 3-month and 10-year curve, I do believe it's probably underway. And if you take a look at this chart, you'll see that every inversion typically leads to a recession within 2 years, and the market doesn't typically bottom until after that. So of course, there's no deep recession priced in. There's definitely some sort of contraction in earnings priced in, but when that deep recession, or if that deep recession does take place, where things like housing or a credit crisis happens, then of course we're going to see high market risk premiums, and that's when you'll be most handsomely rewarded. But again, how can you predict that? You're not going to be able to. The only way you can take advantage of that is if you have chips aside. But if it doesn't happen, you have to live with the consequences, which is of course not participating in any upside from here. So to conclude, where should you put your money in the chips that you want to have on the table? Now, I'm not going to give you a percentage. That's totally up to you to decide, whether it be 50% in, 50% out. But where do you put them in? Based on the market risk premium of recent history and risk-free rate, you're going to want to have at least 10% compounded annually, which does seem pretty hard. So I don't know if we're going to get that on the indexes, to be honest. You'll of course want to potentially be in stocks that are already beat down, because in any black swan event or crisis, their downside is going to be a little bit more limited, ideally. Now, depending on the circumstances of any potential crisis, you're going to want to look for sectors that are going to continue to grow, whether it be a recession or just growth in technology. Now, a lot of people are talking about a shift from growth to value, and that's assuming rates stay high for a long time. Now, that is one scenario where rates do stay high for a longer period of time. The other scenario is something breaks, and of course then the Fed starts printing money again. So based on everything I've looked at right now, the markets are fairly valued, but you're gonna have to pick your spots, and it probably makes sense to keep some cash aside if we see a black swan event or crisis take place in the next year or so, because that could be the opportunity of a lifetime. But again, right now you still have an opportunity to dollar cost average at the very least. So that's just my personal opinion. That's what I'm going to start doing. If you want to know what I'm buying, of course, stay updated by subscribing to this channel and join the Discord and newsletter link below. Hope to see you on the next one.